Hello, Eagle investors. This is Samuel here to talk about single leg options, which is also known as buying calls and buying puts. So typically, single leg options refer to the purchase of either a call or a put by itself, which holds a defined risk and potential unlimited upside for these calls, and an upside so far that the underlying stock goes to zero for puts. So single leg options can move very quickly and allow for great leverage, considered to be long vega with a negative theta as well. So this means they're long volatility and they experience theta decay every single day, losing value. So first, long call option composition. So when purchasing and selecting a long call, there's a few items that you have to pick from. The underlying that you're trading, whether that's Apple stock, Tesla, or a call option on crude oil, or an ETF such as IWM, which is the Russell 2000. And then you pick whether you want to do a call or a put, and and then you look at the strike price. In this example, we have a strike price of 100, and then you look at the expiration cycle, whether it's in the next week, the next month, next 3 months, or a year out. And there's a lot more expiration options and strike options, particularly on more liquid underlyings. So in this example, we see an individual buying a call option with the $100 strike, and you'll see it starts off minus $200 as the premium paid, the amount that this call option costs $200, which is $2 times 100 shares. Now we see the break-even point is $102 on the underlying, because we have to make up for the amount we paid, and then it goes up $100 for every dollar increase in the underlying. So at 105, we'd have $300 of profit. That's 150%. At 110, we'd have we'd have $800 of profit. That's 400% return right there. But the max we can lose is 100%, whether it goes down to just 100, 95, or even 50. So you see the asymmetry in the risk return. Now, depending if we think there's going to be potentially a large move to the upside, it could be a favorable position. Now, it's also worth talking about what goes into this premium, this minus $200, is the extrinsic value and the intrinsic value of an option. Now, the intrinsic value depends on where the underlying is. Now, if it's a $100 strike price and the option's $105, we have $5 of intrinsic value. Now, if it's a $100 strike price and the underlying is anywhere under $100, there's no intrinsic value. Now, the option will still cost money, though, because what's an option? An option gives you the right, but not the obligation to purchase, the security at a predetermined price and a predetermined date. So the other consideration that goes into the premium paid is the extrinsic value, and that's made up of the volatility as well as the time value, in addition to a few other factors. And this makes sense logically in the sense that a very volatile stock has a higher chance of becoming profitable within the expiration cycle. Think Tesla um, versus General Electric. One has a lot more volatility, greater beta. It's more likely to see big swings. So that's priced into the premium. You're going to have to pay more for that option. The next is the time value, right? So which expiration cycle did you choose? If Apple stock is at $170 today and you buy the $200 call option, it's a lot more likely to reach $200 if you go out 2 years and buy that call option, as opposed to you go out 2 weeks, right? So one call option might be pennies, so like $10, $20, and the other might be hundreds of dollars. So now let's look at a long put option composition. It's the same idea as the long call option, just flipped. So instead of having the control over 100 long shares of stock, you're in control of 100 short shares of stock and are able to exercise your option and have those 100 short shares of stock short, sold short at the strike price on or before the expiration date. So again, the max loss is the premium you pay as it's a debit position, but the max profit, it's not infinite because the stock can only go down to zero and go down so much, but it's quite a bit in the sense that it's unlikely that the underlying does fall to zero. So again, the same Apple example, if Apple's at $170 and you buy a put option for $3, that costs you $300 because it's 100 shares. But if Apple were the max profit of the put option would be Apple going to zero. So 170 times 100, that's $17,000, minus your $300 of premium. So $16,700 max potential profit on a $300 investment. Obviously, that's crazy return. It's very unlikely, but it's not quite infinite, but it's very high up there, and it's unlikely to occur. Now, purchasing options. Now, what we have here is an option chain on Tastyworks, which is a great platform and brokerage for option trading. It makes it very easy to set up complex strategies, simple strategies, great fast execution and visualization tools. I made a whole video on brokerage comparisons as well. So I encourage you to check that out if this looks interesting. Now, purchasing options, we have the bid and the ask and the call side and the put side. We also see this expiration and which underlying we're trading. We have this queued up on Apple and the February 18th, 2022 option chain. So what we see here is at the money is about 180 to 175 to 180. That's where the line is. We see that Apple's trading at 176. So if we were to buy the call option here at 180, it costs us $4.6, which would be $460. That's also the max loss, $460. The max profit is infinite. And what we know here is it's important to know the break-even point of this call option in the single leg is the strike price plus the premium you pay. So $184.60 is the point where we will break even. If it's $182, 184.60 is break even. If it's only 182 by expiration, while the underlying has gone up $6 and gone up in value, you end up losing $260 and you're down over 50%. So even though your thesis was right that you think Apple was going to go up, it was a bad position and it didn't go with you because it didn't go up enough. So that will lead me to this slide. So when to use single leg options. So you want to use single leg options sparingly and only with great conviction. And what I mean by that is, we just saw if you have a bullish thesis on Apple, you want to buy a call option, right? That's not always the case, as not only does it have to be bullish and appreciate, but it has to go up quite a bit in order to even break even, let alone experience, the returns that you might be interested in seeing. So consider alternative strategies, whether they're spreads, whether it's stock, whether it's complex option positions. We have videos on all of those as well with Eagle Academy. So check those out and see what's most appropriate and fitting for your thesis. Next is structure an entry and target exit. So ensure a sound thesis upon entry. Again, you have to have a very strong conviction on either upside or downside when buying calls and puts, and you want to make sure that the risk return is in fact there. You think that there's a potential for X amount, potential profits, and the max loss is of course 100%. But can you cut it well before that? Have that plan beforehand before you either are filled with fear or greed, depending on which way the trade has gone. So then you have the upside and downside exit plan before you enter, again, because that's when that's when you're most objective about the position and you're not filled with fear and greed, or, you don't want to risk the money that's already in it, or you want to double down, or you get greedy with the appreciation and you kind of just hold until something bad happens. So then you want to stick with the plan, right? You have that target upside and downside. You have your price levels beforehand and you watch them happen. So you stick with that plan and you execute. You want to trade robotically, right? Eliminate the emotion out of trading. So again, next up is you want to understand what drives the price. So calls and puts, they don't just move with the underlying price. Consider the volatility implications and the theta decay. So we talked about all the Greeks and hedging options in that video, and how to manage options and understand, delta, theta, vega, as well as gamma. And the biggest ones here to look at to at least start are the volatility implications and theta decay. Now, when you only buy calls and puts, you might be completely balanced from a delta perspective, which is like that market risk. If the whole market goes up a lot or down a lot or is flat, you might be just fine from the sense that, you have an equal amount weighted calls and puts. But depending on the volatility and what's happening with the contracts, you could actually lose a lot of money in terms of if there's a volatility contraction or there's a lot of market chop, right? If you're in a bunch of calls and puts, nothing's going to be profitable there. As you saw, the move has to be great to even experience break even. So if you're only in calls and puts, you're actually long volatility and you might not have that thesis. So you might want to consider hedging that or minimizing that volatility risk by diversifying up the strategy, by entering more credit positions, and by entering spreads to have the long call and the long put, but also, farther out on the option chain and the strikes, having that short call and that short put to minimize your vega value. Next is theta decay. When you're long the call and the put, you're experiencing theta decay every day, right? Especially as expiration nears. So to minimize that, either want to cut early or mix up those credit and debit positions. Again, similar to the volatility implications. So what happens with market chop? Like I mentioned, calls and puts often suffer with a choppy market, even if delta neutral. So we can minimize this by varying up our strategies, by not staying in positions as far as they until expiration, because like I said, theta decay rapidly increases as expiration nears, and by understanding the cyclical nature of volatility and the relative value in or the relative volatility of a particular underlying. In Tastyworks, you can look at IV rank, look at the IV of the different expiration cycles on the option chain, as well as just look at where the VIX is. That's a good representation of how expensive these calls and puts may be. So consider those before entering and being overexposed to something you might not have known about or consider to be an important factor in trading and managing an active portfolio. So in summary, long or single leg options can be favorable positions in certain circumstances, but they also hold challenges and a set of risks that you need to understand and manage accordingly. So having a strategy, sticking to it, and understanding how to manage the risks is critical. And I encourage you to understand the volatility, the theta implications. Understand that just because you're bullish on a stock doesn't mean call options are the answer. Just because you're bearish doesn't mean put options are the answer. There's a lot of different ways to manage and to hedge and to execute on your given thesis in the marketplace. I hope you enjoyed this video, and thank you.